Welcome back to Primary Source China Investment. This week we're on show R3. Peng.guo and I are here, so let's get into it. We talk a lot about fixed income on this show, and although the last few shows have really dealt with a lot of the happenings in the equity market, this week we're flipping it back to fixed income. And anybody that's been paying attention knows there are a few key facts about the fixed income market in China. One, it's the second largest fixed income market in the world. Two, the sovereign rating for China government debt, S&P, is A+. And three, while renminbi has depreciated against the dollar recently, historically, volatility is generally low. So let's talk about these 3 points: yields, defaults, and renminbi. So Peng.guo, which one we want to talk about? Yields, defaults, or renminbi?
That's starting from the yield.
Okay, so from the yield, this is probably the biggest story, and not a lot of people are paying attention, but the China 10-year moved down from January, and the rest of the planet moved up. So year to date, yields are down in China, which means bonds are up, and the rest of the world, yields moved up. So while prices in China have moved up, new money has more and better options. For example, the US 10-year began the year at 165 and is now 296. During that time, China went from 283 to 264. So you're finding higher yields in the US with higher credit quality in the US. Similarly in Europe. Remember, at the beginning of the year, most yields were negative. So now the German 10-year is 122, France is 180, German sovereign rating is AAA, and France is AA. So that's what's happened with yields.
From the yield, we also monitor like the 5-year treasury bond ETF. So, yeah, it's very clearly since December 2020, treasury bond ETF is in the uptrend. The return is pretty good. For this year, we reached the 2.45% of the return.
That's year-to-date return?
Yes, that's the return for the treasury bond.
That's in renminbi, onshore in renminbi.
That's right, yeah.
So that's actually a good to take us into a second point, which is for US dollar investor, it's actually not been so attractive. We've had renminbi depreciation of about 7.2%. So that headwind has taken out all of the yield for US dollar investors. So remember, the only real game in town is CBON, and you can see CBON is down about 6.5% year to date, because remember, you're going in with US dollar, the ETF is flipping that to renminbi, and you're buying renminbi denominated assets, and then to come out, you're going to have the FX risk as well.
Yeah, and also, if you see the US, that's most active TNT, the 20-year treasury bond, is always in the downtrend for almost 2 years. That's pretty clear.
Right. That's yield, because yield has gone up, right? So
exactly. Yeah.
That means new money going in is getting that higher yield. So that's why you're seeing a lot of new money going in. Just one point about asset allocation, though, right? Because if you're investing in China, and we've always been a proponent of buying some fixed income, right? So if you're a US investor looking at China and you bought the CSI 300, which is down 20% year to date, and you bought the CBON, which is down 6.5% year to date, on an asset allocation, perspective, yeah, it's down, but it's down less. It's sort of it's a rainy day, yeah, but it could have been a flooding day. That's where your asset allocation should blunt you from the worst of the downturns.
That's right. Basically, right now, China is the second largest economy. So due to a lot of the fundamental characters different from the United States, so China definitely have the different business cycle, money policy cycle. Use the China Central Bank, follow the Federal Reserve, and make the adjustment for their policy. But they also have a dependency. They can decide how to adjust the internal market. They have the tools. So, for example, recently they just released the reserve fund and added the money to the market, push the interest rate, dropped a little bit. The first goal is to really keep the economy as well as the foreign currency rate relatively stable.
Right.
I think they did a pretty good job to keep the stable. Even the entire market, you can see all the sectors get high volatilities to doing like that. Definitely it's not easy keep such big entities to relatively stable in the market.
China also facing, just on the macro side, China facing a slowdown. There's no way to sugarcoat this. So
exactly, yeah.
There are a lot of things that Beijing wants to step in and try to moderate. There's a big debate going on. I don't want to get into that big debate today about is there stimulus, is there not stimulus, but we did have the third point that we wanted to talk about vis-a-vis the fixed income market, and that's defaults, right? So you can't talk about fixed income in China and defaults without talking about property and property developers. So it was announced earlier this week that the government will guarantee some new issuance from Harfor, Country Garden, and a few others. It should be noted that these are the bonds that are onshore in renminbi and guaranteed by the state-sponsored China bond issuance or insurer. I can't remember what the name was here. So this is basically the bond insurer of China. So they're going to, in U.S. parlance, they're going to wrap these bonds. So they're going to property developers are going to issue, and then China bond issuance or insurer is going to wrap these bonds. So take away the credit risk of these bonds. That's onshore. For the offshore market, things are worse. As of the end of July, there's been 19 defaults. 18 of them have been developers. That's already more than 2021. And I'd just like to say, if subscribers haven't gotten the message about investing in China, the only logical conclusion you can make is buy assets that are onshore in renminbi. Otherwise, you risk a lot of regulatory, a lot of asymmetric risks that it's very difficult to model.
We know the problem, and that is a defect in the real estate development model. From micro perspective, they started with a defect. But the problem is the high growth in the past decades covered those defects and problem. Right. And sooner or later, the plus with the population's structure get a huge change. All those problems get pop up.
Right.
You are right. It's the government is most of the time get involved. Is really is try to keep the society stable. From those perspectives, they get involved in the market and try to save it and try to motivate and use the different resource to save it. This is much bigger than just bond default. And all those problem, yeah, definitely they do activity in the domestic, which means that the domestic bond get a higher secure or get a more recovery efforts than the international bond.
The problem I think you are articulating very accurately is real estate for this long period of time benefited the government, in terms of growth rate, also benefited the retail people because, real estate was up and to the right curve. Everybody that bought real estate made money. So that is in the process maybe of unwinding a little bit. And
yeah, it's really China faces the fundamental shift and the fundamental problem and the reconstruction the economy right now. So obviously, this is will generate huge risk for the individual investors, no matter in China or in the international investors.
Yep.
So people have to see or be aware of this huge risk, and also that might be bring huge opportunities to see.
Well, if you're a distressed guy, you may understand this a lot better. So we're going to leave it here with show R3. Fixed income is not going away. Need to understand a little bit better. But we'll be back next week with a new topic, and we'll see you then. Thanks.
Thank you.